Hi guys, in this video we are going to learn about what's meant by the yield of a debt. So first of all we are going to discuss here is irredeemable bond. So what's meant by the irredeemable bond? First of all you need to understand what's meant by the bond first. So we are going to look at that first. If you are new to this expert tutor channel, please spend some minutes to subscribe our channel. Please do that fast. Okay, I hope you have already done that. Okay, let's move to the topic. So first of all, we need to understand what's meant by the bond. So what mean by the bond is it's similar to a bank loan. Let's say there's a company, a big company, and they are going to broaden their company. So they need some money. What they can do is they can issue some shares to the capital market, or that what they can do is they can borrow money for loan from the loan providers. So that's the way this is known as the bond. It's a way to get the loan from other entities or other investors. So here, what's the benefit uh, for issuing bond than share is? Actually, we knew that when you are providing the shares for external investors, the ownership percentage of that company from you is going to reduce if you give away that shares. But if you're issuing bonds, which means it's similar to debt, so the ownership won't be changed, won't be affected by that bond issue. So that's the benefit of providing bonds than shares. Okay, let's move on. So here, what they are going to do is, let's say they need $1 million for loan, for the capital, for like an amount for broadening up their company. So what they can do is they are going to issue some bonds for external providers. What I mean by the bond is, let's say it's like a paper and it seems like this. So for a investor, we are going to provide 500 bonds and the signature like that. This is a paper. So in this paper, they have mentioned that there is 500 bonds and what's the rate of that like that. So here what they are going to do is normally the value of one bond is $100. This is known as the nominal value, which simply means when the providers, when the loan issuers or when the bond issuers are providing that bonds, they are going to have a value. So that's the nominal value, the initial value of that bond. Normally it's going to be $100 nominal value. This is known as nominal value. So this is $100 normally. So over here, what they can do is, if they are selling 500 bonds, which means they are going to get $50,000 from the investors. So if they get $50,000, they are going to sell that 500 bonds. It's simply a paper, like an agreement. So 500 bonds they have bought. So this is known as bonds. So we are going to get that amount, and we are once the thing is, it's like a bank loan, similar to a loan. But once we pay the interest, so once we pay the amount, we need to actually give the interest too. So likewise here in this bond also we are going to pay some interest for that owner, the bond owner. So here what the company do is annually they pay a interest for that bond. So the thing is, it's going to be a fixed value. The fixed percentage is known as, it's very known as coupon rate. So you need to know this one also. So this interest rate, the special name for that bonds interest rate, the percentage of that interest is going to be coupon rate. So what mean by that is, let's say they have bought 500 bonds for nominal value, so that the nominal value is actually, if they mention about the nominal value, you can easily figure it out. This is going to be 100. So 500 bonds means 500 into $100 per bond, each bond. So if you multiply that, you are going to get $50,000. So let's say the coupon rate is 7%, which simply means they are going to pay the interest annually, the 7% of that $100, from the nominal value. When they are giving the coupon rate, you need to multiply it by the nominal value. So it's going to be 100 into 7%, which means you are going to get $7 annually. But he has bought 500 bonds, so we need to multiply it by 500. So it's going to be $3,500. So which means after the first year, he is going to have, sorry, this is 50,000. So after the first year, he is going to have the return of $305,000. So the next thing is, so this is a basic thing. So the next thing is, there are two different types. One is irredeemable bond, and the next one is redeemable bond. What's meant by the irredeemable bond is actually when they have sell their bonds for you. Actually, sometimes you might sell that after a long period. Let's say the company is issuing bonds, 10,000 bonds. So 10,000 bonds with the nominal value of $100. So what they are going to do is after 3 years, they are going to repay your loan. After 3 years, they are going to repay your loan. So which means you can get the settlement again. So if the A investor bought that bonds from you, 500 bonds, he is going to invest in a $100 nominal value. So which means it's going to be $50,000. Once the coupon rate, let's say this is 7%, so that he is going to get annually $3,500 per 3 years. So actually they are planning to hold up for 3 years. Let's say the A is planning to hold up that bond for 3 years, so he's going to get the annual return of 3,500. So for the 3 years they are going to get 3 into 3,500. After the 3 years, what the A can do is he should give these 500 bonds again to that company. What the company do is they will return the money. So the thing is, sometimes they will agree in the beginning only, they will agree to buy that bonds for the same rate, or which means for the $100. Sometimes this is known as the par value, which means it's the same value to the nominal value. So they will repay at the par value. Sometimes what they do is they will give some premium amount. So this is known as, let's say they are going to get $20 premiums, which means for each bonds they already bought, they are going to get $120 once they settling up that total bonds after the 3 years. So this is known as the settlement. So there is a par value. Sometimes they might give for par value, and sometimes they might give the premium amount. Why they are giving this premium amount is to attract the investors. Let's say if you are going to buy some bonds in a market, what we will check that is whether they will return, what's the return would be higher. So that if they are giving about 120 at the final year, so we are going to go with that. So this is known as redeemable bond, which means after 3 years, we are going to redeem that bonds. So what's mean by the irredeemable bonds is they are not going to repay that amount for you. So which means you are going to hold that for longer years. They are not going to repay that. Then there's might be a doubt about how they can get the money, how the investor A can get that money. They the invested money on this the company. How what they can do is actually bond can be traded in capital market like shares. So actually we knew that in the capital market we can bought shares and sold shares. So likewise here the A, what A can do is A can directly sell that bonds, 500 bonds, to another investor who is willing to buy that 500 bonds. So likewise, they can trade that in capital market. Also, the redeemable bond can be traded in that capital market. So if you don't like to uh, waste their time in that investment, what they can do is they can easily sold out in the capital market. So it's like a very similar to shares. So this is the brief introduction to bonds. So the next thing is we are going to check up with what's mean by the yield of irredeemable bonds. So we are moving to this video's topic, irredeemable bond. So actually you need to know what's mean by the yield. The term yield simply means the yield is the return you are going to get, or the return what the investor is going to get. Let's say here, so actually I have already raised that. So the A is going to buy 500 bonds. The nominal value of bonds is $100. If they didn't mention about that, you can easily directly take it like $100, as normally the general way of the bonds issue will have the nominal value of $100. So the next thing is they have mentioned the coupon rate of that bond is 7 percentage, and let's say that is irredeemable bond. So after 3 years you can't sell that to that same company, which means it's irredeemable. You can't sell to that. You won't get the repayment from the companies, which means you can directly sell that for any other investors who are willing to buy that. So this is a coupon rate of 7 percentage, and let's say the current market value is $95. So what's mean by the current market value is, actually I have already mentioned that in the capital market you can directly sell that bond like shares. So at that time, what's the value of that bond in that capital market is known as current market value. At that time, if you sell that, you're going to get $95. So I have given this for doing a question. So what's mean by the yield is, actually the investor, the A, is going to get the amount of that interest, 7 percentage interest, to himself. Also for the return, this is also one type of return. The next type of return, once he is selling this bond to another investor, he is going to get something as return. Sometimes it might be losses. So if he bought for $100 and if he is going to sell that for $95, definitely it's going to be $5 loss. Sometimes it might be higher than the nominal value. So there might be two returns, two types of returns. So one is the from this interest, and the next one is by selling that bonds to the capital market. As it's a redeemable bond, you are not going to sell that for company, or you are not going to settle up to that company. So over here, how to find the yield? What's the rate that we are going to get from the irredeemable bond? Once, before you are going to invest, you need to check what's the yield of that investment. What's the percentage you are going to get after that investment? So how you can calculate that yield for the irredeemable bond is, it's very simple. You need to check what's the interest you are going to get for 1 year. So actually we knew that it's going to be $100 at 7% rate, which means you are going to get $7 per bond. So we are going to put that interest rate over here. So interest, we are going to get $7 per bond. Sometimes they might got some doubt, like it's actually this, the current market value is 95. The coupon, if the coupon rate is 7%, why can't we multiply by this one, 7%, 95 into 7%? Actually, the what's mean by the coupon rate is the interest rate is already fixed to that nominal value. So you need to remember that. So you are going to multiply it by the nominal value of the bond. They are not going to change. It's going to be the percentage of that nominal value. So the interest for that year would be $7. So after that, you need to divide it by the current market value. It's going to be $95 into 100. This would be the percentage, which is 5.26 percentage. So that if you invest in that bond, now you are going to get 5.26 percentage of return for within a year. So that's the meaning of this yield of irredeemable bond. So here we have learned about the irredeemable bond. In our next video we are going to check out with the redeemable bond, yield of a redeemable bond. I hope this video would be useful. If you have any suggestions, please comment it below. Thank you for watching.